All right, good afternoon, everybody. This is Gavin McGuire, event trader, and I am going to be joined by Brett Manning, chart trader, to discuss the latest in sentiment and flow data out there in the market. So, Brett, how are you doing today?
Doing pretty good, Gav. How are you?
Doing good, doing good. We had a little bit of a hiatus last week, but we're back in the saddle and a little bit of a different landscape for us to discuss. I figure we'll take a look at some of the recent sentiment data, of course, obviously the market action going on. We were able to get the Bank of America Fund Manager survey today, too, so we could cut through that and take a look, as well as some of the recent flow data that we've been looking at, and how that's all kind of rolled into where we stand with sentiment right now. So, Brett, I guess first things first, why don't we discuss over the last 2 weeks what you've been seeing in the market? I think it's pretty much played out with what the base case we've been talking about for the last couple of weeks that
Yes,
we laid
indeed.
out. So, what are you seeing here?
No, I mean it's exactly the process that we described at this point. It is a bunch of people who are managing large amounts of money who had a consensus position of skepticism in a situation where there were a number of different themes that could evolve toward forcing them in a kind of game theory dilemma to chase the market. And especially coming at this time of year, I mean, that's what we're seeing. I don't think that there's a tremendous amount of conviction in the money that's coming in, but there's no way that they cannot reposition themselves to at least index up a bit, index to the index to inflation, index to all sorts of things that have to do with a world that there was a consensus skepticism about, which is a world that could possibly have some kind of real organic growth in a world where all of the catalysts in terms of geopolitics were stacking back toward, friendly neighborhood for a period of time, and that there was a kind of fake cycle end, even if it becomes a real cycle end. Right now, it has to be treated like it was a head fake over the summer and in August and September, and that this is, that there's going to be leading indicators showing the opposite direction. We'll see where they actually go, but right now there's no way, if you're a money manager, if you're not exposed to that possibility, there's no way that you can stop yourself, I think, from chasing this to some extent. And that's what we're
Right.
seeing.
And I think one of the more interesting aspects too, and we'll break into these on a case by case basis, is we've certainly seen a turnaround in the data on the sentiment side, certainly from the fund managers survey. Big whips back towards a more positive read. Sentiment data hasn't really changed as much, I would say, but we'll talk a little bit about the zoo survey and the small business survey from this morning too. And I guess the thing that was kind of striking me as a little bit odd, Brett, and I think you kind of laid it out as well in your commentary, is that we really haven't gotten a blown off top by any stretch of the imagination, considering some of the bounce backs that we've gotten in some of the sentiment data. So perhaps people are just a little bit cautious, like you said, until things uh, get get done. But it's just interesting the fact that we were up near highs when sentiment data was poor, and then we've seen a pretty big whip back into the other direction, particularly on the cash side of things. But I really haven't gotten that euphoric rally that one would expect with such a move, I think.
No, but I mean the S&P's up 200 points in the last month in a straight line with almost every day going up. I mean it hasn't gone into kind of a fever pitch, um,
Right.
but I feel like that's a possibility here if we, especially if we shake out back down and then immediately move back up, put a tail or two in on attempts to break down and really kind of get a sense of urgency for people who have kind of been sitting there either fading this or still saying on the sidelines and saying this is the market is wrong, what's it doing? Eventually it's a process of conversion until you convert everybody who's vulnerable to being converted. Everybody who really, when put to the test, is vulnerable to being converted will be converted. And that's what a trend is. It's the process of going through and exploiting every possible conversion and making it all happen, using that resource entirely up before that is the end of the trend. And I would think in this situation, given how vehement some of the skepticism has been, and for legitimate reasons, certainly legitimate reasons, how consensus, the idea, for instance, of no inflation got to in August and September. Look at what we saw in the bond market. I mean, that all folds together into a big picture that says there's just no way that the cycle in the sort of the spirit of the cycle can really flourish and blossom again for another leg. And that was just locked in across assets and across exposure. And now as you start to push asset prices higher and you get this big dilemma that I talked about quite a bit in the chart book at the end of October, this process of the White House starting to change their messaging theme. And if China doesn't step in and challenge it, then, you know, if you're not long this market, you got a real problem. If the White House continues to start to say everything's on track, we might even roll back some tariffs, and who knows. And I think that you're going to continue to see us, you know, just crawling in the direction of that messaging theme, which really should push not only the markets, but like you said, the other, you know, softer economic data, where you start to see upstream supply managers have to kind of go through a pent-up process of you know, chasing inventory.
Right. I guess the one aspect that could make this chasing inventory a little bit tougher is, and we'll see a little bit of that rolled out over the next 2 days, 3 days, really, the impeachment process, as well as poll data that plays out over the next couple of months too, especially since it feels like most national polls have Trump trailing. You know, Biden. I saw the latest one that he was 6 points behind Bloomberg,
Sure.
which is amazing that you could have a poll that he's beyond Bloomberg, even though Bloomberg.
But shouldn't that just throw gasoline on the fire?
Well, it definitely could, because obviously then that start. I don't think people trust the polls as much as they did back in 2016.
No,
I would say. So I think people have kind of learned their lessons from that, but. It'll be interesting to see how much their policy commentary will play out in the markets, because obviously it's going to be impossible to get anything through, especially with the Democrat-controlled House.
But let me just suggest that if you're in this administration and you're thinking about how you're going to go about this campaign, whoever it ends up being that you're up against.
Oh, you're running on the economy at this point.
Well, it's not just that. You're thinking about swing states. You're thinking about the electoral college, and you're thinking about two things, really. You're thinking about industrial supply chain and farming.
Right.
Right. I mean, you're thinking about you're thinking
Midwest, Pennsylvania.
You're thinking about the steel mills, such as they are, and the farms. And how do you Michigan and Pennsylvania and everything, and then the entire farming belt, like that's your swing state mix, and that's who's been hit the hardest by the entire China narrative, and so I think really swinging that back in the other direction with a gas pedal is what they would want to do, and as we said last week or 2 weeks ago, the real obstacle would be China. If China doesn't let them get away with that narrative that this is all proceeding toward the nice tidy ending that they're trying to message around, if China really puts a block in, and I think that comes down to whether or not China wants Trump in there, which they might. I mean, they honestly might, and that's going to be a big question mark. If China allows.
Well, without a doubt, I think the biggest question mark for 2020 is who's going to be on the opposite side of Trump.
Absolutely, because you've got really two different parties on the left now.
Yeah.
Completely two different parties. And which one he's running against, it changes everything. But China certainly, it could want Trump in there. And the question is, do they really let him get away with the narrative that this deal is really on track as far as how it's messaged through the election? And if that's the case, then if you're not long the equities market, then you're going to be in trouble, because you're going to have a benchmark to match up against, and that's the whole FOMO idea on an institutional level.
Right, and like I said, we're seeing that playing out in a few areas where there's certainly some money being put to play, and I guess we'll start off with the sentiment data here first, Brett. Then we could break into the fund manager survey and a couple of the other surveys from earlier today that I'd be curious to hear your thoughts on, and then we could wrap it up with a look at Powell, although this might be the biggest non-event for the Fed in 2 years, I think, given that for the first time in a long time the Fed and the market seem to be on the same page together. But
Hmm.
taking
Right.
a look at the data on the sentiment side, really didn't get as euphoric as I would have expected, given
Not
some of the
yet.
turnarounds. Not yet, not yet. So I, I think that's one thing to keep in mind as we were talking about in terms of there's still some upside to this. But one of the things that is jumping out to me, and we'll get into a fund manager survey, is the mutual fund cash level, which continues to slip into the excessive optimism side on this, and it's really been on a steady move upwards in trajectory, lower in trajectory, meaning the market's going upwards. So I'm just kind of interested to
For
see.
2 decades.
For,
Let's just.
right,
I mean,
right.
there's a structural theme there, I think, which is one of the reasons why I don't look at that as much, because I think that it's a financial technology issue that fund managers don't need as much cash as they used to in the
That, that
1990s and
that they're able
1980s.
to do more through different leveraging
They're
instruments.
yeah, they're finding ways to protect themselves in other ways, I think, and there's more complex strategies now rather than just a lump of dollar bills in a safe. I think that's part of what you're seeing. But also remember that's a very lagging indicator. The last data point we have on that is the end of September. And we still had, I mean, can you imagine? It probably is lower now. And that shows up in the fund manager survey as well. Probably we're seeing a lot of cash. Even though that indicator shows a very low amount of cash, um, I imagine that it's even lower now. But the other thing to compare that with, and we talked about this 2 weeks ago, is the margin debt level. And I focus on this in my chart book as well. If you look at margin debt, typically over the course of any major cycle, you'll see um, you'll see margin debt really lever up with the market. It's usually kind of right in line with it. And if for anybody who wants to look at that past chart book, I have a chart showing how there's this in sync point where you get this kind of exponential curve upward in margin debt. On the NYSE, it's 200,000, 300,000 in the late 1990s when we have that blow off going off in 99 and 2000. Then again, at the end of, 06, 07, 08, when we start to get the move up to the final highs, I think it's October '07, it kind of has the same exponential lift to it. And right now, we're seeing new highs in the market with margin debt way off its highs. And that essentially means there's not a lot of leverage in this market, even though it's moving higher. So you can talk about cash, but you also need to talk about leverage, because either way you're talking about ammunition, like buying power. So cash is a problem if it's too low because it represents a lack of buying power. But again, we've got financial technology to deal with, and we've got leverage to deal with. So that's a lagging indicator, and there's more than just cash that can drive this thing, especially since the retail investor is, by this data, almost completely unlevered to the market.
Yeah, and I think it was something that you brought up a couple of weeks ago that was of interest, just with the lack of stock splits and
Oh,
everything.
I
And
thought
really,
that was so interesting.
and it really just kind of speaks to either no need for the retail subscriber to get in, but do you think the retail is just I don't want to say on a buyer's strike by any stretch, but it's just wrapped up in different ways in terms of like more likely to
I
get
think so.
ETFs. Like I got a lot of friends that will talk to me all the time about investing and what they should buy, and they'll be like, I think banks are great, and I'll just tell them to buy the XLF or something if
Mhm.
they just want that. And certainly it feels like there's a lot more of that going on. Now, I would say if we're just looking at your SPY liquidity premium or anything, it's not playing out in that, but I would assume that there's probably a good ETF, the inverse ETF volume that's died down, but still ETFs have probably maybe just replaced the average retail investor in stocks. Do you think that's the case, and therefore a little bit less volatility on a equity by equity basis?
So I think there's a multifactorial explanation. I think, for one, the lack of stock splits during the course of this entire bull market is probably one of the most identifying, signifying things that you can say about this bull market and how its place in history. If you look at financial history and the history of markets, this is the odd one, and it's odd for that reason. It's odd because it means companies do not need to use capital markets on the equity side to fund business. They do not need retail investors, more or less. They don't need to market to them. The money is there, and the money is coming through institutional channels and possibly ETFs as well. That's part of it. I think there's also a demographic explanation. I think that you've got the baby boomers at a time of life where they're not playing the stock market very much, and they're looking at how to preserve and gradually spend their nest egg rather than build it dramatically through investments. And I think that it's one of the things that we talked about the kind of the odd the odd sense of why really lowering interest rates isn't working necessarily the way that policymakers want it to. There's kind of a counterintuitive notion here. You'd think that if you lower interest rates enough, one of the things it's supposed to do is force wealthy individuals to move their money from interest-bearing assets into equities and more aggressive and more risky securities.
Right.
And that's supposed to have kind of a feedback loop that is a virtuous circle for the economy and for all sorts
not tied up in long-term fixed income.
But the problem is when you get to a certain point in life, all you do when the whatever interest-bearing investment you have, when the interest rate is lower and your payout is less, what people seem to do, and this has been a problem in Japan, instead of moving their money into a riskier security, they just spend less because the income coming from that is less. So they just spend less. So it has the exact opposite impact on the economy because you've got a bunch of wealthy, older capital owners who want to be making 2 or 3%, but now they're making, 0.5%, and so they're just going to spend less this month. And so it's just rather than forcing them into chasing Apple shares. So I think that there's been a demographic problem and a process, and I think that that's tied also into what we see with stock splits. I think that the way that we've got a lot of really young people and a lot of really old people, and not a lot of people who are more or less you're in my age right now. It's what's called a poor demographic dividend. You've got a lot of millennials and younger, and a lot of baby boomers and older. Those are the two biggest generations in the history of this country. And right in the middle is sort of the Gen Xers and Gen Ys or whatever they're called. If you're born in the late 60s through the early 80s. You're kind of in a smaller demographic right now, and that's the age that typically would fuel the stock market from the retail side. Is just like when the baby boomers were in this age, somewhere in their 40s where they're making the most, they've got the most disposable income. That's when the 1990s happened. That's one of the reasons why the 1990s was the 1990s. It's because the biggest generation in the history of our country was in that period of their lives where they have the most disposable income and they're willing to place aggressive investments to build nest eggs. And right now we have essentially the opposite situation. So I think that's part of it too.
Right. Taking a look around at some of the other measurements that have gone into extreme optimism, Brett. We've got the risk appetite index that's hitting extreme optimism for the first time. It did it about 2 weeks ago, but really last time we saw it over this level with any sort of continuation would have been back in April of 2019, so earlier this year. But that's starting to get up there. Any thoughts on the risk appetite index?
So that's one of these where it leans heavily on movements in markets rather than asking people what they think about markets or looking at different hedging instruments. So you're seeing the S&P there, really. The risk appetite index is bolting up because people are dropping their hedges, because they've got to drop their hedges because they need to be indexed to this market. And you're seeing it probably in credit spreads shutting tight, in maybe probably gold is in there somewhere, and gold has been declining. So all of these different market indicators, it's a pool of market indicators that are supposed to show when people are nervous or when they're not. So risk appetite, when it goes up a lot, that's because this thing is seeing a bunch of different indicators saying that people aren't scared. And that's, of course, true because the market's at all-time highs, and it's part of the process of blowing off. But it doesn't necessarily show in a one-point data point. It doesn't really speak to how much pent-up energy there might be left to blow this off further. And that's going to be a process. We're coming from deep skepticism and deep malpositioning to a situation where people have to at least price in the risk that there's going to be a major continuation to this economic cycle and this bull market, even if it doesn't happen. Even if we're talking 6 months from now saying that was a big fake out. In fact, that's kind of my base case. That's why I call the last chart book euphoric head fake. Right? I kind of feel, to me, like that's what makes the most sense here, especially when you look at yield curve, things like that. Like historically, this is what happens. You get the first inversion, then you get the move back above. You get this new steepener trade that really is kind of the final leg of the cycle, and then things roll over. That's a very typical process. I feel like that could be exactly what we're seeing here. I don't think there's a tremendous amount of conviction in what's happening, but I think that money managers are still forced to position for the risk that this really has another major leg in front of it. And that's going to mean, you really can't hedge with, let's say, big shorts in high yield debt. You really can't hedge in being super levered up on gold. If you start to move toward, I've got to have my performance mirror what would happen if every asset class starts acting as if this is 1998 or 1999 or 2000. I need to be positioned so that I'm not left out and losing my job at the end of the year. So I can't be sitting here holding all this gold and this, long bonds and basically, shorting or long wide credit spreads, high risk credit spreads. And positioning myself long yen, et cetera. Like they can't hold those positions anymore because of what's happening in the market. So you're seeing this indicator adjust to people essentially dumping their skepticism portfolio, I would say.
All right, and just we're keeping an eye on the markets here too. S&P slipping down towards session lows, NASDAQ under pressure. We basically have had a rollover since the early morning with that 3100 providing a little bit of resistance here. Twilio is another name that we'll be keeping a close eye on. That's obviously been getting hit pretty hard on the idea that it could be losing its largest customer, WhatsApp. That was rumored before. Stocks coming in right around that 90 area. If you recall, I was short this a couple of days ago. And this 90 area is where we ran into a little bit of resistance to the downside, or support, I should say, and we got the bounce back. So it's back to testing that level. If you're curious, the early reports that I'm seeing has WhatsApp pegged at about 3 to 6% of revenues for Twilio. Uber, another large customer, which has obviously been having some trouble too, so that's probably weighing in on these shares here, and we'll keep an eye on it in the broader market as we discuss things here. So, Brett, we talked a little bit about some of the sentiment data, so why don't we pop over and take a look at the fund manager survey and what's coming out of there, because definitely it seemed like to turn the page and a 180 from what we were seeing about 2 weeks ago, the last time we met. Now, one of the things that was jumping out to me was that there is no excess. The comment that they said the easy part of the rally is over, the tougher part of the rally is beginning. Basically what they're talking about here is no excess greed, which points to that leverage ratio you were talking about, and there's no excess liquidity in. So I think you kind of touched upon it there earlier. Also, the other item that they were jumping out to, talking about the cash levels falling from 5% to 4.2%. This marked the biggest monthly drop in cash since November 16. That, of course, was the election, when we saw that huge overnight whip around that really set off the latest leg of the rally, I guess we could call it. Now we got cash levels at the lowest level, according to
and they were double tapped, by the way. Brexit and then Trump.
Right, yeah.
The double tap of the bears, bang, bang.
Yeah, exactly. So once the floodgates opened up there, people were willing to put their money together. But we got cash now at the lowest level since June of 2013. So anything to add from what you said earlier with regards to these two topics after hearing those numbers?
Yeah, no, I mean, I think that this is the process we were looking for, and I don't think that that's just that move, that shift immediately is going to be. That's it. I think that this is a process where I think you will see probably, like I said, it's a process of conversion. I think that there's conversion yet to see. We'll see it in the other indicators that we were just talking about as this process goes until we get to what you get in that phase of a bull market where people were. I mean, it really does. Without the retail investor flows, it certainly changes the complexion of it. But there is a process that is an echo right now of late 1998 in terms of. And I don't think you maybe get the 2 years of crazy parabolic movement because, you don't have the baby boomers sitting there at 45 years old and, really, for the first time understanding what E-Trade is and pouring all their money into it. But I think that the idea that you've got this snapping to the upside and people having to chase performances is something that I think hasn't fully played out, and I think you'd see probably by the time it's over. I mean, you've got the lowest since June 13. I imagine that you'd see like a 2-decade low in cash levels at the time that we're kind of really seeing the end of the flower.
Right. One of the things that struck me as interesting, and I'll also read some comments from the zoo surveys earlier, but global growth optimism surged by the most in 20 years to an 18-month high. This is implying global PMIs to come in around 53 to 55%, and the global EPS growth to be 3 to 5%. This is the first time in a year investors are also looking for more companies to increase capex than rather reduce debt or improve balance sheets. And I really think that Europe is one of the key levels on this. This is why I went long the EWG a couple of weeks ago, and looking, I feel like one of the things that we're talking about when we're not really seeing that euphoric pop off to the with the money money coming off the sidelines is I feel like we're seeing more go into the emerging markets and some of the other European markets just because they've been so much of a laggard. And
so much.
With that in mind, and that's something to keep in mind too. It's it's that rising tide lifts all boats, and the U.S. boat's already been floating pretty high
really
for a
important.
while.
Everybody, you need to, if you're just used to looking at the S&P every day, take a look at the MSCI All World Index, take a look at Germany, take a look at, scroll through some charts for international markets, and you'll see that the one consistent thing that's been happening in this world for over the last maybe 5 years, maybe the only thing, is a divergence of the United States from the rest of the world in equity prices.
A big outperformance. I think Alarian had a pretty good tweet out about it, about just talking about some of the divergences. But with the zoo indicator today, Brett, so it increased substantially. It went from it went to a minus 2.1%. The indicator had climbed 20.7 points compared to the previous month. The current assessment of the economic situation in Germany improved slightly by 0.6%, with the corresponding indicator increasing to a current reading of minus 24.7 points. So basically what that is a lot of the boost for the zoo survey was for the forward-looking outlook, and I think that's important in terms of where you're looking for where money goes to work. That's why I've been talking about Germany and some of the other areas the last couple of weeks. But the reasoning for this jump up, Brett, I thought that was pretty interesting. So the comment was there's a growing hope that the international economic policy environment will improve in the near future, which explains the sharp rise in the zoo indicator of economic sentiment in November. In the meantime, the chances for an agreement between Great Britain and the EU, and thus for a regulated withdrawal of Great Britain, have noticeably increased. Punitive tariffs on car imports from the EU to the United States are also less likely than the projections a few weeks ago. And an agreement in the trade conflict between the U.S. and China is appearing more likely too. These were from ZOO President Akim Wambach. So a lot of that pop in sentiment, and it probably makes sense because a lot of the negative sentiment was due to three pretty important ducks getting lined up in a row. So I think that this kind of plays into your cautious optimism comment from earlier, wouldn't you say?
Well, I mean, I think it's it's electoral politics. We're seeing what they used to call the presidential cycle, which was kind of debunked, a few decades ago. But the idea that if you look back in the late 1800s and the early part of the 20th century, there was a relatively identifiable pattern where administrations in the United States in power would essentially start off their 4-year term by deflating the economy and then ramp it up like crazy in the 18 months ahead of the next election. And that was just about, one party keeping control. It's easier to inflate something that's been deflated first. So there was a very clear kind of movement. And this administration, given its tactics around international trade, could kind of be seen to be the first administration maybe in 50 years to really match up with that pattern again. And at least I think that's part of the sentiment here, is saying we're headed into the presidential election in the United States. Trump has inserted himself as a central figure in a lot of these major issues that you just summarized. And if this is going to be, for instance, he's not going to want to cause a big tariff fight with Europe for the same reasons he wants to make the sentiment around what's going on with China seem like it's headed toward a successful resolution where it's, an inflationary outcome across asset classes. And that's for Europe and China from the United States and based on the campaign cycle in the United States. And then there is Brexit, which is sort of a separate issue, but there's a little bit of electoral politics going on there and party control and trying to get a result. And it's also that's just kind of ripened to the point where I think that everybody's just so sick of being in the process of this, even in the UK, that, there probably is more likely compromise.
Right. Okay. So one of the important aspects from the survey too, Brett, kind of plays into the inflation commentary we've been talking about, and that's the expectations for a steeper yield curve are at its highest since November 6, 2016. Again, the election year certainly helps explain why financials are at the forefront of this recent rally.
It's the leaning wrong portfolio, is it not?
Yes, exactly.
It's the sudden outperformance of the leaning wrong portfolio.
Well, and building upon that as well, is the U.S. dollar outlook is the weakest since September 2007. What makes that interesting to me is the fact that I think most people are of the viewpoint that the Fed's on hold right now. They've gotten to 3 insurance rate cuts. This is per usual whenever they're doing an insurance rate cutting cycle. And yet the outlook on the U.S. dollar has really kind of cratered. I mean, that's the weakest since September of 2007. We're getting back into the Lehman years and stuff. So it really plays out on that leaning wrong portfolio. And it's led to people buying value banks in the Eurozone while they're selling cash bonds, utilities, and staples.
Yeah,
and that's
right. It's confidence. I mean, usually when you see a confident part of the cycle, you see the dollar not do so well.
Yeah.
So it's that swing. It's the same swing. It's kind of coming across everything where people are, and I don't think it's a bold step toward a new revelation. I really think that it is actually fear of being wrong about the skepticism. It's the bad version of a rally in terms of how people feel while it's happening. I think right now.
Yeah.
Maybe not before it's over, but right now this is a tremendous amount of malpositioning trying to be shifted around in a hurry.
And then continuing the theme of the leaning wrong portfolio is 84% say the Fed won't raise rates before the 2020 U.S. elections, so a hawkish Fed could unwind stubborn long positions in U.S. tech growth and treasuries. 52% say stocks are the best performing asset class in 2020. 21% say commodities. So the other bear surprise is stocks, PMIs, and earnings per share all top very early next year. The idea, again, the leaning wrong portfolio here, where people just aren't expecting runaway growth, and particularly
they're not positioned for it. There was a consensus.
They're simply not positioned for it. And
there was a consensus that's now at risk of being badly wrong.
Right, and I do think that Powell kind of laid out the terms when he was talking in his last meeting about a very high level of a very high bar for inflation to surpass in order to get them moving to the upside. But that's really remains kind of the unwind trade if things were to start getting out of hand with the inflation front. So really for me, the next 3-4 months, inflation remains the key read, just because it very likely will be a non-event, but it's the second it's not it is an event, that's going to really raise a lot of red flags and I think rattle markets in terms of redistribution of investment.
It's going to be really interesting to see how they handle it. I mean, eventually it's going to happen. And it's going to be really interesting to see how I tend to think that we've got this next level out kind of sloshing back and forth thing that happens throughout history where inflation is concerned, where there's just this giant boogeyman, and it's either wearing an inflation mask or it's wearing a deflation mask. And, in the 30s it was wearing the deflation mask, and the whole culture of policymakers and academic research and everything else evolved up through the course of decades following that, understanding what they needed to be afraid of was deflation. And that led to an inflationary, terrible moment in the 1970s because they were so busy trying to protect against deflation for so long. Then the boogeyman started wearing an inflation mask because of what happened in the 70s. In the 80s and 90s, it was the inflation mask until, I think 2008. And, it pushed us, and the process that we've seen over the last decade where, it's recreated this culture of policymakers that feel like, oh, inflation is a great thing and deflation is the terrible thing. So the boogeyman is now wearing the deflation mask, which means we're going to be running away from that. And eventually, that's going to drive us into the arms of the boogeyman wearing the inflation mask. And it's just how
long will it take is the
you
question.
put in place this structural bias in terms of the outcome distribution. I think there's just a greater percentage chance of an inflationary problem over the course of it could be, 15, 20 years from now. I don't know. But we're gradually gearing reality toward manifesting that outcome at some point because it is ultimately tied to, factors that we have some control over. And as we start to really kind of only recognize that there's one enemy, the other enemy is obviously going to be what we get. And it'll be interesting to see that process as it takes shape because the first step would be what's probably going to happen where we're going to start to get some inflation and, there's no way they're going to try to shut it down because they're so happy to see it. It's like, it's like somebody who's dying of thirst seeing, a river rushing at them. They're going to be really welcoming that river, and eventually they'll be the person who's drowning.
Right.
And it just, but at the first reaction to a higher than expected inflation, even something that looks a little problematic, maybe from the standpoint of the world as it was in the 80s and 90s, will probably be welcomed and fostered and nurtured, and we probably aren't going to see a Fed that's overly hawkish in reaction. So that may play into what you're talking about in the other direction, that we may see actually a bullish catalyst because we get the first glimpse of that monster, and the Fed says, hey, this is great.
Yeah, and more likely than anything, because the amount of stories you see around the Japanification of the U.S. and everything, and really Japan has kind of set off this whole deflationary argument because of their inability to reinflate, and then you just kind of stockpile on the entire 2007 crisis and the 10 years since with the central bank activity. It's really
we've been dying of thirst.
It's really led to that boogeyman coming in.
Yeah.
But let's just cherry pick a couple of more things from the BOFA Global Fund Survey, and then we will circle back and take a quick glimpse ahead at Powell tomorrow. But one of the more impressive things was the growth expectations jumped 43 points from minus 37% to a net of 6%. Now, this isn't necessarily high by any stretch, that 6%, but certainly a bounce off the lows. The minus 37, as we were talking about this too, that's kind of in the territory of where we were for a lot of 2007 through 9. Also in 2006, we saw that kind of preview, a look ahead, and before that.
Let me just insert. So he's talking about the following question. A bunch of large fund managers were asked, how do you think? Go ahead.
How do you think the global real economy will develop over the next 12 months? And right, so it had been running around near decade lows, basically, the last couple of months.
In other words, here comes a recession.
Yes.
Was what everybody was thinking for, the better part of the last year. So that's where large money managers were on that question. The sample size in the survey is very good. So that's where we were in terms of expectations. That's why interest rates just went back down. That's why the 10-year was back down at 1.5. It's this idea. This is, here we are. We had a cycle. Well, that's all over now. And so that's the leaning wrong portfolio. That's the idea of suddenly you get everything breaking out. What if you get this pent-up demand from upstream supply chain? What if you get leading indicators flipping around? People just were not positioned for that. So this is the whole theme that we're talking about, I think really ties into this question on this survey in a lot of ways.
Right. Just a heads up, we are paying attention to Larry Kudlow. Markets bouncing a little bit as the positive narrative is making its way around there. He's talking about progress, no specific timing on anything. So again, there's just a lot of loose money being floated around here. And at the end of the day, a 18-point move in the S&P throughout the course of the session, given the amount of run-up that we've had, it's not something I get too wrapped up in. So next up, quick look at the global EPS indicator for it, where they are looking at EPS, earnings per share, of course, growth to be about 3.7% for the next 3 months. This was versus the minus 3% year-over-year consensus. We've talked a lot about the earnings recession that's been in play here. But you got to think, Brett, that 2020 model, if things get lined up, there's going to be a lot of easy comps for people to beat.
It's the opposite of what we talked about last year, isn't it?
Yeah.
Do you remember?
Where we had the tax package that really made for difficult comps, and with the backdrop of it, now you're going to get that completely flipped on its head. So the valuation
people are just getting swung back and forth around this year over year, and it's gonna. What does that set up for next year? Pretty darn good.
Yeah, especially you got to figure with the presidential path going down, there'll be a lot of promises about further rate cuts too.
I want to jump back too, because one of the other things. So last year, Gavin and I talked a lot in October, September, October, November about big problems for comparisons that we would see. That 2019 was like a comp hell for on a lot of different levels, and a lot of it had to do with when the tax reform bill, which was effectively gigantic fiscal stimulus in the United States, with an effective window that was really for the latter half of 2018, third quarter 2018, really dead center, ground zero. And so when you're comparing to August and September of this year, you've got these terrible year-over-years. And one of the other points, though, and this is really interesting, and we haven't talked about this, is one of the other big boogeymen for 2019 was rolling over commercial paper and corporate debt.
Right.
And lo and behold, the bond market really delivered a giant gift on that one.
Yeah.
So the cycle extending power of that phenomenon should be appreciated.
It's funny because it's still there. It's always going to be there, but until we see credit markets crack, which never was really any signs of that in 2019.
Well, they've rolled over a huge amount of paper though now. Like we
extended
reset
maturities
at low rates. Yes. Yeah. Big time, and this was a problem when we talked about it.
Well, in 2018 too, because we had rates on the rise, right?
Yeah, so you're thinking we're gonna stop issuing corporate debt. They're gonna start doing secondary offerings. There's gonna be a bunch more shares. This market's gonna get crushed. That's what would have happened in a world where the bond market didn't skyrocket and interest rates drop into this big inversion over the summer. But because it did, all this, we just smoothed through, just kind of, extending maturities, rolling over paper. I mean, we saw some big deals come out, right? I mean, we talked a couple months ago about, who was it? Somebody did just a massive rollover. But there's been a number of companies that have kind of piled into this, which really, has a major implications for extending the cycle and feeds into now the credibility, the possibility of another serious leg.
All right. Next, Exhibit 7. What do you expect to be the top performing asset class in 2020? 52% of the survey respondents have equities, 21% commodities, and only 10% cash. So certainly seems like that people are going to be leaning in that direction. They also noted that fixed income is last, despite long U.S. Treasuries being the most crowded trade from June through October of 2019. And that in itself is pretty interesting as well, because that suggests to me the possibility of an unwind.
What was it? What was the point you just made?
So they
crowded trade?
Which asset classes would perform the best in 2020? Equities was the top asset class at 52%, commodities at 21%, and then you had cash at 10%. Then next up would be government bonds and corporate bonds. and
Right.
so this came in last. I mean, government bonds were slightly
I
ahead of
see where you're
corporate
going.
bonds.
No, right.
So
This is the unwind. Yeah,
yeah, so the
exactly right.
idea is, do we see a massive unwind? Because we've been talking a lot about it with the flow data throughout the course of 2019. Everybody was just piling into bonds and out of equities. Now do we see that whip around, and does that lead to the blow off top where you don't need the retailer, you just need the institutional investor
Yeah,
that is
exactly.
willing to sell his bonds in order to take advantage of the higher yield in equities? We've heard a lot about the chasing a yield, and certainly with these bonds at such low levels. I mean, we've been talking for 2-3 years now about the 14 trillion in debt that's in negative territory. Do we
Right.
see that great unwind in 2020, and is that what could cause us to see the big blow off on the
Yeah,
equity
I mean,
side?
you're right. You've got almost got a scarcity value to shares. So much capital raising has been done through debt markets. It's been so pivotal in this entire cycle, and the size of the U.S. equities market has just shrunk and shrunk and shrunk because they're paying out through buybacks constantly, right? I mean, that's how you're returning money to investors now as a corporation, a publicly traded company in the U.S. is just huge buyback programs and never issuing any shares, and it's kind of like there's kind of a scarcity chase too dimension to it. And if we see that debt market turn around, interest rates rise, and we start to see companies lean on the equity markets again more, you could almost look at from a 30,000-foot view that's how you get this kind of final blow-off leg and then a reversal, on a very large time frame.
Right. Next up, Brett, Exhibit 8. And it'll be a little bit tougher to translate this verbally rather than having a chart. But the question is, at what level will the S&P 500 index peak in the bull market? The majority.
Gotta love these questions, right?
Yeah, yeah. And I mean, they're always very wide and open ended, and I'm sure. But the problem is, if they allowed people to put a comment space, they'd have to limit it to about 60,000 words, probably, for a
No,
lot of
yeah,
these
but I
responses.
love the fact that this is the question that they ask all these large fund managers. I think it's a great product.
Right. So, but it is interesting response because the majority fall in that 3030 to 3250 area. This is the second time in a row that this has been. And so obviously not a ton of
There's that
upside at
lack of
that point.
conviction. There's the lack of
Right.
conviction right there. You
But
gotta buy, but only for the next month or two.
exactly. The lack of conviction, I think, is the perfect way to put it. Next up, though, is the 3250 to 3500 area. That's trailing at about half the respondents to the other area. And then the third is above 3,500. So there is definitely a lean over that. And then we already peaked at 3030. That came in last place, but probably most notable, that was the second place answer
Yes, I was gonna say
the
same
last
thing.
time around. So that
Right, last month that was the second place winner was where we've already passed.
yeah, we've already peaked, and then the first
There's the
place was
same dynamic, yeah, the lack of conviction, the lack of real faith in this being a real thing that's happening. Sure, I've got to buy the market now, but clearly, you know.
well, see, there's a lack of conviction there, but there's also, I would say, pretty strong conviction that it's not to the downside, right? Like, the lack of conviction is how much upside we have more so than, I don't know if we're going up or down,
No, yeah, right,
right,
sure.
based around
But
this.
it's
So,
up a little bit more, and I've got to buy.
right, which is certainly in
Yeah,
stark
but I mean, you can see
contrast to
the
what we saw prior.
procession when we see this answer for the next one. If we're past, you know, whatever 3250, then that's the leader now, and then that will look just like that 3031. You know what I
Yeah,
mean? Like we're willing to say it's definitely going higher, but can't be going that much higher, and then just rinse and repeat.
right. Okay. Then looking at the biggest tail risks for the market, trade war continues to be the top. I think this is, I'm going to say, probably 14 of the last 15 months trade war. China slowdown was
But
one of
it's
them.
got a new meaning now. I think it's got a new meaning now, and it comes to the core of everything we're talking about. It's a tail risk,
But
but
the
for both
upside.
shorts and longs.
Yeah. Yeah, I agree with that.
This is the fear, the uncomfortable rally. Like I don't, because you're going. It's this. That's the catalyst. It's just in the other direction.
Right. Okay, most crowded trade again, coming in at long U.S. tech and growth names that has surpassed long U.S. Treasuries now,
Right.
which U.S. Treasuries had been the biggest one for the last 5 months, but long U.S. tech last time it was the most crowded was in May of 2019 here. So, just taking a look at it at the NASDAQ, you could see when that was the most crowded trade, all of a sudden we saw the NASDAQ tumble from 79.20 to close out May at 71.85. So that'll be something to keep an eye out on for the tech space, particularly since you'll see a lot of people talking about the bloodbath from last December. I don't think people are expecting any sort of seasonality there. But
The one thing I would point out, the other thing that's wrapped up in that answer is that that's the part of the market being cited as problematically valued is not the leaning wrong portfolio, but is upside risk asset. You know what I mean?
yeah,
So
no,
there's a notion here that there are stocks that are value plays, and when are they going to get their turn?
right. So again, we'll have to see how this all plays out over the course of the next few months. So, Brett, before we turn to Powell, is there anything else from the survey that I've left out that you wanted to cover?
No, I think that we pretty much exhaustively and comprehensively went through it.
Yeah, so a lot of good information there as per usual. But we have Powell on deck tomorrow, and to be perfectly honest, that we'll if there's anything of great interest, I'll pull Brett on and we'll discuss it on audio. But I really think that he's kind of hit his stride after the first year here and is really understanding what the market wants to hear. And I just think that we've got
School of hard knocks.
yeah, School of Hard Knocks for sure, and we've seen that from all of them really.
Oh,
Yellen, I mean,
sure.
maybe not to the extent, but
I think this is the most
Yellen
that I've
also,
seen.
yeah. Well, I would say this.
Toughest audience.
Yellen also didn't have a Twitter account following her every move and hammering her on
It's
top
crazy.
of it and turning it into bigger news probably.
I honestly, just as an aside, I genuinely am concerned about who wants the job next. Who would want that job?
I mean, I guess it would depend on who's at the top, right? But
Yeah,
I mean,
no, right. But I mean, if
I'm
we've got
more
four more
concerned.
years,
I'm more concerned
who
that it's
would
somebody
want the job?
who's not concerned about it because they're just going to be a yes man and drive us into negative rates.
Either way you want to take that question, I think that it's very difficult to get legitimate, credible, really top tier talent to want to have that happen to their life.
Yeah. So that'll be interesting. But again, what the only thing that I could really think of, Brett, is if he did falter on the comment where he said that there would be a very high bar in order for them to raise rates again. If there was any sort of commentary about economics data is getting better, earnings are getting better, so the upside isn't as much of a isn't we're getting closer to that bar or something. Now I can't imagine he does pull an about face. I think if anything, this needs to be a little bit of a victory lap for him, and he could spend most of the time getting hammered by
Yep.
the Capitol Hill folks into whatever their projects are for their area, but I can't imagine him trying to move too much. I mean, and we've seen that consistently with Clarida being the latest this morning, and with all the Fed speakers really just kind of sticking to the script here and not looking to rattle the bond market. So I think if anything, Powell is going to be pretty short and sweet on his answers and not look to rock this boat one bit. So I wouldn't expect this to be a big news item, particularly when you're going to have all the cameras on the impeachment hearings and all the focus there. I think Powell's got to be just thanking his stars that this is going to be going on, because he's probably not even going to have to worry about it, the Twitter account following him, because that'll be wrapped up in another area too. So anything that you could think of from Powell that could impact markets tomorrow?
No, I mean,
Outside
I
that
think
scenario that I laid out.
no, I just think where we are in the grand scheme here of this particular Fed and this policy cycle is we had what we could call like a mid-cycle adjustment or whatever he wants to call it, and it was the 3 cuts, and it's all sort of lined up, just according to the theory here. But it also represents a reminder of who the boogeyman is, and I think that Powell would really be just glowing, and he would be celebrated by other central bankers around the world if we had 3% inflation. Don't you think that he'd be so happy to be able to say, I got it up to 3% inflation?
Oh, but not moving the target.
No, just that's what inflation's coming in at.
Yeah.
That would be a terrible thing if you go back in, a decade, but or 15 years or whatever. But now I think that it's like, to central bankers, like, if you are able to create inflation with your policy management, boy, you're the hero. So I just think there's no chance you're going to hear anything hawkish at this point. I mean, we'd have to see a really dramatic shift in things. There's only one case being made that's credible where it could lean in that direction at all, and the people who are dissenting, they're not dissenting because of inflation. They're dissenting because they're concerned that the downside, when everything does finally fall apart, which it will, is going to be much worse because we're nursing along asset pricing problems, particularly in low-grade credit. And you're getting a buildup of misappropriation of funds that's really unhealthy for the economy. And that's where Rosengren would be, and that's where George would be, and that's where these people who are dissenting, that's really the argument that they would make, is that we're nursing a much bigger disaster in the future if we're allowing this kind of, where the punch bowls just sit out in front of everybody with asset prices already in a situation where maybe it's a little bit crazy.
Yeah. All right. Well, anything else to add before we end here, Brett?
No, I think we've pretty much run the gamut. So we got kind of the scenario we've been mapping out. And if you've got, if you've just got a basic investment portfolio in the market, aside from your trading book, you want it to be fully in gear right now.
Yeah.
And we're just kind of blooming the flower on top of the pile of poop that we saw over the summer. And
that's certainly one way of looking at it.
Yeah, this is that flower sprouting right out of that.
All right. Well, Brett, thanks as per usual for joining us here, and we'll continue to play out these scenarios as we go along in the Sentiment and Flow Show.
All right. Thanks a lot, Gav.
All right. Take care.